first thing is you have to speak the same language. You have to use the same language as insurance. I mean, if you go out and buy an insurance policy that's got, 100 or so pages to it, and you write a check and you've paid for the premium, where do you move the dots on your risk matrix? That's not clear. I don't know how to do that. Now, if you're talking about things like a loss exceeds curve and probabilities of various events occurring, and what your impacts would be if those events occurred, and how insurance might mitigate some of those impacts, well, we know the math for that. So why not at least speak that language? And you get a lot of other benefits out of speaking that language. The other benefit you get is that now you can use data. Now if we get new observations, we can update our model with additional uncertainty reduction. Actually, it's kind of fascinating that even if you have to start out with subjective estimates themselves are not necessarily a bad thing when it comes to math, okay? You can measure the performance of the experts' subjective estimates. This is something you can track over time. But here's something to realize. Some subjective estimation methods measurably outperform others. There's a lot of subjective estimation methods you could be using. You don't want to use the subjective estimation methods that don't improve anything. You want to use subjective estimation methods that do. And it turns out that one of them is if you decompose the sources of your uncertainty, like for example, you're using a Monte Carlo simulation, or you're using subjective estimates to inform a Bayesian network. Even if that's initially subjective, the output, on average, outperforms the unaided intuition of your subject matter experts. This also just happens to allow for the consideration for insurance. You should allow insurance to be one of the tools in the toolbox. It's just like another set of controls or patches, etc. It's just part of the whole solution. And how do we even figure out how much insurance we need if we're just ranking controls and patches based on high, medium, low stuff? That doesn't even inform that. We have to monetize risk so that you can monetize risk reduction. Then you can actually compute return on control and figure out how much insurance should matter in your situation.
All right, and
Steve, you've been in the industry for a while on the insurance side. So let me turn the table slightly here and actually ask the moderator, because you've been a part of risk quantification companies, cyber, and you've been part of cyber MGAs. What's been your experience when it comes to cyber insurance, and why is almost everybody pissed off at all cybersecurity insurance vendors? What's been your views?
Yeah, so definitely a lot of different views that I can take on this. I think, and certainly anybody in the audience who is dealing with their cyber insurance renewals right now is probably not the happiest. Unfortunately what's happened, right, the last couple of years was sort of this arms race for market share, right, where you had more and more carriers entering the industry and offering higher limits at lower premiums, right, to capture those clients. Now they were underwriting those risks by asking 4 questions. What's your revenue? How many records do you have? Have you had a breach in the last 3 years? We know that doesn't tell us anything about the actual risk, right? As they've started to elevate in their maturity, they've added more questions or more stringent underwriting requirements and do, leverage some third-party external analysis. But again, right, that's giving insights into potential indicators of compromise, not the actual risk of that given insured. And we see, with some of the customer discovery that we've done with CISOs, on the enterprise side, where they're feeling the effects right now that they're being priced to market, not priced to their actual risk, right? So that they've invested, however many dollars over the last year to improve, right, their security posture. But because the industry's loss ratio, got drastically worse than the year before, and a lot of players are now offloading a portion of their portfolio, and renewal rates are increasing anywhere from 50 to 100% plus. That CISO's in a position where all that work that he did for the last year is now not accounted and represented for, right? And particularly as we're talking about bridging that gap between the IT and the risk management, CFO, board. If the insurance isn't aligned and in part driven by the CISO, right, as core to that conversation, it provides for the environment that we're in today, where carriers are offering renewal quotes at significantly reduced limits and significantly increased premiums, right? And very limited options in the market. So the question really right then is where do we go from here? How do we solve this problem? It's not a problem just for insureds, it's a problem for the whole ecosystem, right? For insurers, obviously, because it's not sustainable to operate like this. And we as insureds want to know that we have coverage. There's some certainty and trust into why we're transferring this risk. And to that, Saket, I'd love to get your thoughts around, how do we start to elevate the industry, from an underwriting perspective, and what are some of those? How do we capture some of those insights, right? From inside the company, not just externally what we see, like akin to taking a picture of somebody and oh, they look fine, they look fine, haven't gained much weight over the last year. I think the risk is the same, and not doing a blood test or an EKG, right? How do we get to that blood test or EKG within the world of cyber risk?
So I like what Doug says, and I'm going to copy your line here, Doug. You say you always have more data than you need, and you always need less data than what you actually think you need, right? So then what you have. So the point I'm making there is that the data is already there. If you think about it, cybersecurity investments are off the charts. In terms of growth, this is an industry growing at 16% CAGR. It's a $150 billion industry. Where is that investment going? It's all going into your cybersecurity products, services, and every product has insights. Every product has alerts and scores and dashboards which are there. There is no underwriting which is utilizing it. If you think about it, I was talking to a CISO of a $3 billion retail company, and he says he just renewed it, very pissed off with the renewals because the premiums went up over 150%, and he was quizzed by his carrier and the broker, and on the quiz, while he went on that call, the question was, do you have an antivirus? He said, yes, I have an EDR. Okay, which one is that? CrowdStrike. All right, next question. And he was like, it's almost a joke that...
It's like, do you like your firewall?
Yeah, exactly, right? So it's unfortunately a joke in terms of how underwriting happens today. Not just questionnaire based, but also outside-in assessment, because outside-in assessment is not only inaccurate, but it's misleading. And we spoke about that in the morning, that sometimes when you get the wrong, not only the signals, but also you have the wrong data science, it can actually mislead you. And that's the reason why last year the loss ratios of cyber insurance as an industry went up from 42% to 72%. And that's such a big alarm for the whole industry. So in my view, the only way in which you can get real data, and there's no secret here, is to get to the real data. And the real data is with your EDR, with your vulnerability assessment tool, with your Azure Security Center, with your O365, and they all have it. And the beauty there is you can use APIs to put that together, make that into a measurably better mathematical model, and there are plenty of them which you can be using there. And if you put that together, we feel we can make a pretty significant impact on really disrupting the whole cyber insurance industry the way it is today.
Well, and building on that point, and something that you said earlier, Doug, right now, so many organizations and enterprises purchase, cyber insurance limits, relative to a percentage of their overall revenue and what their peers buy, right? So because their peers buy $30 million of cyber insurance coverage, that's, what our exposure roughly is. We should get $30 million of cyber insurance, right? The notion of, doing that quantification exercise, on a real-time and ongoing basis to even provide that insight up front, right, as to what that exposure is, so you can make a strategic decision around risk mitigation and risk transfer. Is transformative in and of itself. But something we were talking about last night, Doug, which I thought was a really interesting topic, is there's always a lot of talk in the cyber insurance world, right, that there's not enough historical data, and I often question the validity of that historical data, as it is the most dynamic risk in the world. But what are your thoughts as to that notion?
Yeah, I mentioned this before too, but it is true, you do have more data than you think, and you need less data than you think. Sometimes I run into this. Here's a very simple problem that I use in one of the books. It's called the urn of mystery example. I've got an urn, it's filled with marbles, maybe 1 million marbles, and every marble in that urn is either red or green. And what you don't know is the proportion of marbles that are red. So you start sampling marbles, and the first 8 you sample are green. Can I work out the probability that the next marble I draw is red? Statistics says yes. Statistics, using something called Laplace's rule of succession, by the way, very simple formula, says 10%. And by the way, you can check this in simulations. For those of you who want to get handy with simulations, you can easily check this sort of thing out. Randomly generate the proportion of marbles that are red, and then do this experiment over and over again and see how often the next marble is a red marble after drawing 8 gray marbles. It's 10%. The lack of an event so far is not a lack of data about that event. If you've gone 5 years in your new organization and you haven't observed a ransomware attack yet, that's not completely uninformative about the chance of a ransomware attack. That tells you something about the rate of ransomware attacks. Now, it's still a high level of uncertainty. There's still a lot of uncertainty. There's definitely things you should do to measure it further. But think of measurement as uncertainty reduction, not the elimination of uncertainty. This is absolutely key. Not only does insurance need to be able to quantify uncertainty, if there wasn't uncertainty, there wouldn't be insurance. Right? Either no one would sell you the insurance because they know you're going to have the event, or you would know for a fact you don't need it.
Insurance is if all else fails.
On anything, not life insurance or health insurance or fire or auto insurance, none of that. It's all probabilistic. You have to spread your bets out, but you can be intelligent about how you spread your bets, right? And this is a lot of what cybersecurity is about, and managing cyber risk is about. It's spreading out your bets in an intelligent way. Think about it like a portfolio optimization problem. Now, earlier you asked the question, how do we introduce this? How do we get this going? Well, a good place to start is the realization that it doesn't have to be that complicated. Relatively simple, low-hanging fruit improvements are a huge improvement over unaided intuition or qualitative methods, or not even insuring yourself at all, or just go with the first quote you get for an insurance company, right? All of those are suboptimal compared to even a marginal improvement. So think about introducing quantitative methods as a marginal affair. You're incrementally improving things. You make more observations and reduce uncertainty further, and then you can further optimize your decisions. So that's an important part of it. The other thing you got to do, by the way, is it can be a specialization. If you're in a big organization, it's not like the CISO or CIO has to be the quant guy. You can have one quantitative analyst. There's a lot you're used to in organizations that are medium-sized or larger having specialists. This could be just another specialist. There used to be insurance companies in the 19th century before there were actuaries. Actuaries evolved as a specialty out of necessity to survive as an insurance company. The same thing can happen here.
Well, yeah, and it's, you look at an insurer like Affiliated FM on the property side who goes in and inspects every property that they insure. Where's the cyber insurance industry on doing same? Right, and Saket, what I'm curious to hear from you, just as you've been engaging with the Fortune 1000, is what resources are you seeing are being pulled in from those organizations to support the quantification exercise and just coming to that understanding?
It comes back, Steve, to what we spoke in the morning. The biggest risk in risk management is getting your risk management metric wrong, right? I've seen this often. Generally, the cybersecurity products which are procured are not the ones that you needed the most, but is the one where the salesperson persisted the most. And it generally is the case if you think about it, right? Oh yeah, there's been somebody who's been pestering me, and I've heard Gartner and Forrester say okay things about them. You know what, maybe I'll give it a shot, right? However, what would that technology or type of cybersecurity product have an impact? Because when you say yes to something, you're also saying no to something. And what is that impact to your risk posture? What is your acceptable risk? What is your residual risk, which is after implementing those controls which are out there? Generally, that's not calculated. I'm talking about a Fortune 25 company that I was talking to one of the board members with, and this was as recent as last week. they don't even discuss what is the meaning or what is the acceptable or the residual risk in cyber in their board meetings. They all get a 70-page report every board meeting, 70, which everybody says, frankly, right?
It's like reading an insurance.
Yeah, it's like reading an insurance policy, exactly, right? It's like, we know we'll not understand, but it needs to be there because compliance needs us to talk about it. We know it's a big risk, but we don't know what to do about it. And that's the problem, as Doug said, you need to start with the right vocabulary, which everybody understands, and a common vocabulary which is accepted by everybody, which is just not out there. So most of these Fortune 1000 companies, coming back to your question, Steve, we've actually seen a very positive trend. We know of not one but multiple companies which are investing full-time resources to say, as Doug said, have somebody who comes with some degree of quantitative background, who can come in and make sense. And it doesn't need to be a super complex equation that you need to come up with and say, hey, this is how it works, right? A lot of very simple low-hanging fruits can actually measurably give you better results than red, amber, green, and things like that. Think about it, right? JP Morgan Chase and their CEO, Jamie Dimon, after spending over $1 billion in cybersecurity, still says my number one risk is cyber, and I don't think I have that under control, right? And that's him publicly saying that. So that is the problem, I feel, and that's where you need to get towards, where you get the right investments in people, process, and technology to quantify your risk in a measurably better way, to start the program, to set the base of where you are. And when you know where you are, you can aim at where to go and set the expectations with everybody. Now, if you have anything to add to this.
No, absolutely. Ditto all of the above. Absolutely. There's a lot of great tools to start with for things like this. So you're not starting from scratch anyway. You're not having to bring in an actuary to derive, new rules of probability from Kamal-Rav's axioms. We're talking about existing tools, existing methods that have been around for a long time. We didn't have to invent anything, including people risk. That's not a new thing. Do insurance companies have to insure against theft and other things? Of course. Health even, they're not predicting our own behavior necessarily with health, but they have a lot of data on these sorts of things. You actually do have quite a lot of data now on the frequency of occurrence of cybersecurity risk, really by industry. It's even highly segmented by this point in time. There's a lot more data in cyber than many other fields where Lloyd's of London routinely insures. They insured the first launches of communication satellites on SpaceX rockets. How much data did they have for that? Not much, just the failure rates of previous rockets. That's what they had. So very little data. Yeah, you've got a lot of data on this stuff now.
Yeah, and I know we're sort of wrapping up on time here, but I think the notion, and I can't, coming from the insurance industry, agree more of getting to that common understanding. Right, I was talking with a CIO earlier who, is in the middle of their insurance renewal, and their insurer is mandating that they introduce a new PAM, privileged access management solution. And the CIO knows that, well, yes, I can do that and need to do that, but that's not going to have the biggest impact in actually reducing our risk, right? So, you have two different schools of thought and two different knowledge bases that are, attacking this problem in an uncoordinated way. And I think that provides for a lot of opportunity to...
Before we wrap up, can I mention real quick that I'll be outside here signing books. So
Doug has written this book called How to Measure Anything in Cybersecurity. Must read, in my view, for any cybersecurity professional. So Doug would be at our booth, Safe Security's booth, and please drop by and he can personally sign the book for you.
Free copy.
Free copy. Yes. All right. Thank you, Steve.
Awesome. Yeah, no, thank you guys. Thank you both. Thank you, Doug, Saket. I obviously enjoyed continuing the conversation with you. And thank you all for staying, and please come visit us.
Thank you.